Any other new students?
Bankole.
Bankole, I think okay. It looked like okay. Bankole. Who
Yes,
else
sir.
again? Who else again? Nathaniel, are you just joining us?
No, I was with you for last night.
But you did not write
I wrote,
FR.
I didn't pass FR. I wrote PSAB. I passed PSAB. I didn't pass FR.
What's happen? FR that's very cheap. That's no,
I didn't give FR enough attention like I gave PSAB.
you will pass this guy by God's grace.
Amen.
No cause for alarm. So let me just start the class proper because I don't want us to actually waste the time. Maybe the first time. My name is Ambassador Lushola Pius Oshashona. I'm the lead lecturer for FR, and I will also be taking a miscellaneous standard for strategic business reporting, that is also known as a CR. So I was told by my colleague that he has run you through the introduction aspect, which has to do with conceptual framework. Yes or yes? Is that true? Michael
Yes.
said he has run you through the conceptual framework. Yes or yes, right?
Yes, sir.
That is very good. So I will just start my own from IS1. However, before we start this IS1, for the people that are writing for the second time, maybe FR, or you just join the professional league, I want to give you something. Let me just tell you how I pass my CR for those that are in the final. Like I said, I registered for CR. I paid tutor's fees, but I got a particular job then and it was demanding. I was unable to attend class. But because I have a knowledge of FR, what did I do? I was just collecting the notes, read on my own with the help of other friends. I was able to score very high in CR. However, I want to warn you guys in CR. CR and FR is the most simplest course or paper in ICANN that you can easily pass. Let me tell you this. Any student that are saying, I've heard about a particular standard, I will not attend that class, that person is tend to fail. Let me tell you something. Why I understand standard very well is because more or less repetition. Yes, I hear it more than 2 times, more than 3 times. Let me tell you something. If somebody mention his name time to time to you, you won't forget it for life. So also for you to understand standard or to pass FR or CR, you need to keep familiar. As in, don't say, when I was writing FR, I've heard about so I will not attend that class. No, the more you hear about that topic, the more understanding or the more you understand it well. That is the tip for you to actually pass. Like I tell any student, no, it's only God that can reward someone. But there is no how I will teach you FR or CR that you will not be better, at least better than those people that are not even writing. In ICANN, those people that are failed are those people that actually, write an ICANN, maybe they fail one diet or 2 diets, and they quit. Those are the people that actually fail. Let me tell you something like when I was writing then, a friend of mine will be telling us that we better pass those people that did not write. Despite the fact that we fail it. You'll be telling us that we better pass than those people who have not even made the attempt. That is just it. So I want to actually tell you, please pay attention to all the standard. Pay attention. Then for the CR student, let me tell you this. If I can want to test a standard, it's not like FRO. It's not going to be like FR. Let me just prepare your mind. They can use a 20 mark. They can use first standard to test a 20 mark in your CR if they want to test standard. I'm just telling you this. It's not like FR that you have maybe just one standard, a 20 mark. Never. ICANN will never do that for a professional level. just prepare your mind. So every standard at your level, which is a professional, is key. You must understand it. Unlike FR, you are still writing FR, you say, I don't know this standard, they can see, they may not set it. But in your own case, for the CR student, that is, what is it called, strategic business reporting, student, you must know it. Like, if you are a Christian, like the way you know Bible, and if you are a Muslim, the way you know your Quran, that is the tip for you to actually pass. And for the, I foresee something in this diet. Yes, I can tell you there are some standards that you have not really been taught while you are writing your FR. Yes, all those standards like 5 or 6, IFRS and the IAS. And I want to bet you, ICANN will come minimum of 2 from that aspect. For the CR student, I can bet it. Yes, I can bet it. This is the beginning of my class. I'm just telling you what will happen. So, however, all those standards, as we are going, please endeavor to actually join us. We are going to be giving you a short course, a shortcut for you to just do what? Go and pass your right exam and pass it. Then for the FR student, no cause for alarm. Yes, no cause for alarm. As time goes on, I'll be telling you some key area that ICANN cannot do without in this diet. Yes, I've seen the awards last diet, and I was so happy. Yes, this diet, I will still also be telling you in the area that you're supposed to actually focus on. So, however, you too, you need to actually understand standard very well. You need to understand standard very well, though you don't cover the whole standard. And I want to tell you, ICANN cannot set from page 1 to the last page in the exam. They will never. They will just pick from all those standards or from any other topic and set their own exam. So please, do you have any question before we start this topic? The topic before, like I said, is IS1, presentation of financial statement. I'm going to summarize this for you to understand it, especially for those people who are the accountants, finance manager, head of finance, head of accounts, what you need to do, aside even writing ICANN and pass. Those are the things that you are coming here to actually benefit, not even only writing ICANN and pass. So do you have any question before we actually start this lecture? Any question? Anybody that want to say something, please?
Hello, sir.
Yes, go ahead, sir.
Good evening.
Yeah, good evening.
I saw something, was in a publication also that
Sir?
they will be using IAS1 again, that is IFRS 18 now for presentation of financial statement.
Until 2027, sir.
Okay. Okay, sir. Thank you.
Yeah. Any other one? Any other one? Any other one? In the absence of no, let's start this class. Like I said, I'm going to summarize it for you to understand it. So the topic before us is for both FR and strategic business reporting students. IS1, presentation of a financial statement. And let me tell you this, IS1 is in connection to other standards, a lot of standards. Yes, there are some standards that are still referring to IS1. When we get to that level, we actually cross it, like IS8, IS12, IFRS 9, IS7, IS16, IS38, IS40, and so on and so forth. They are keep referring to what? To IS1, because it's more or less the bedrock of other standards, like a pillar to other standards. IS1 set out the overall requirement for the presentation of financial statement, guideline for their structure, and minimal content requirement. It ensures comparability both with the entity financial statement of previous period and with the financial statement of other entity. IS1, let me just break it down for you. Please, if you are just joining us, please, let's move so that we will not disturb each other. However, if you want to ask any question, please, you can just indicate so that we can allow you guys to actually answer it. Like what I am saying, that IS1 is also ensure that there is a comparability. When we are talking about a comparability, you are talking about a previous year. For all these guys that are doing a financial analyst or an accountant, they will say they want to do a forecast. 5 years forecast. Please, move. Let's move, please. Let's move. Everybody, let's move, please. Thank you. Thank you. So, like I said, as an accountant, you'll be able to actually do a comparison. That is, you want to know whether last year performance is better than this year performance. In forecasting, when you want to prepare a forecasting, they will just prepare like maybe a 5 years. They will now compare it year by year to know the year that is going to be better out of this 5 year. Okay, you actually raise up your hand. Oh yeah.
Sir, please, is it possible for you to mute everyone because some of them are not muted?
I'm trying to do that. Let me see. Thank you.
Welcome.
Praise. You must pass this diet by God's grace. Let me mute everybody. So. Okay. So thank you. Like I said, we should be able to actually do a comparison. And let me tell you this, as an accountant, you have gone beyond preparing a financial statement. We should be able to actually prepare and present it to the management by telling them, okay, in 2024, we have so performance, but in 2025, we have so performance. They will ask you, what is the changes? That is percentage changes. What are the reasons that make us to perform better than last year? Or what are the reasons that make last year financial statement is better than this year? As an accountant, you should be able to actually do what? To justify that. That is what IS1 have come to say. The objective of this IS1 is to do what? Is to prescribe the presentation of general purpose financial statement to ensure a comparability over time for the same entity, like that is last year versus this year. Then a comparability with other entity, that is an entity. We have a company A and we have a company B. So we should be able to do a comparison. Okay, whether we're actually performing better than industry B. Those are the things that IS1 have come to say. So IS1 apply to all general purpose financial statements prepared and presented in accordance with International Financial Reporting Standard. It does not apply to interim financial reporting, which is IS 37. That one is for a professional level. That one is for a professional level. So now, let me just summarize something to you. Please listen and listen. The connection between IS1 and other standards, like I said, IS1 is a foundational standard that provides a general presentation principle for financial statement. So it actually sets the structure and format and how work alongside with other standards like IS7. IS7 is talking about statement of financial, it's talking about cash flow statement. So IS1 is connection to this what? To the cash flow statement. That is the presentation of a complete set of financial statement, which must include a cash flow statement. Now let's move to IS8. When we're talking about IS8, IS8 is talking about accounting policy. changes in accounting estimate and error. Is that correct? Accounting policy, changes in accounting estimates and error. So the connection here is that IS1 mentioned that policy and prior period error should be dealt with under IS8. Can you see it now? Now, both standard work together, both IS1 and IS8. They do what? They work together to ensure a consistency and comparability in presentation. Now, let me talk about IS10. IS10 is talking about events after the reporting period. What is now the connection between IS10 and IS1? IS1 requires disclosure of events after the reporting period. IS10 defines which events are adjusting and non-adjusting and how they should be treated. When we get to all this standard, I will share more light. I'm just trying to summarize all the standard that is the connection with IS1. Now, let me talk about IS12. IS12 income tax. The income tax is connected to IS1 because IS1 requires disclosure of tax expense in the income statement. IS12 provides the recognition and measurement rule for current and deferred tax. That is the connection. IS33 is also connected, yes. IS33, NA per share, is connected to IS1. So what is the connection there? The connection is there is that IS1 requires NA per share to be presented on the face of the income statement for listed company. IS33 provide the detailed calculation and method. Now, IFRS 15. Let me mention IFRS 15, revenue from contract with customer. Is also linked or is in connection with IS1. IS1 require presentation of revenue in the statement of profit or loss. IFRS 15 govern how revenue is recognized and measured. These are the connection. Then IFRS 9 as well. Let me say something about IFRS 9. IFRS 9 is talking about financial instrument. What are the connection between IFRS 9 and IS1? IS1 govern how financial assets or liability classify and measure under IFRS 9 are presented on the face of the financial statement. Now let me match together IS16, IS38, IS40. IS16, IS38, IS40. That is all this non-current asset standard. Those are the three. So what are the connection? They are interwoven. The connection is that IS1 require clear presentation of property, plant and equipment, intangible and investment property on the statement of financial position. Also mention about the recognition. It's also mentioned about the measurement, also done under the respective standard. So these are just the summary of where IS1 have a connection. I made mention of IS7, I made mention of IS8, I made mention of IS10, I made mention of IS12, I made mention of IFRS 15, I made mention of IFRS 9, I made mention of IS33. I also talk about the non-current asset, which is IS16, IS38, and IS40. So without the, this standard, which is IS1, all these standards that I've mentioned, it cannot stand on their own. Yes, like I told you, that IS1 is the bedrock, more or less the pillar of all these standards that I mentioned. Before we continue, any question so far, please? Any question? Any question? There should be a question. There should be a question. I expect a question. There are some standards that I actually mentioned, you don't understand it. I expect a question. No question? Okay, that is fine. Let me move on because of the time. I don't want us to actually waste a lot of time. However, if you still have a question, you can just signify. Oluwale Rabi, what is the name? No need of pointing it. You are spoiling the something. The note, please. You are using Biro, Abi. So now let me talk about, okay, can anybody explain the component of a complete set of financial statement? So mention them, we have 5. Then can you just give us a summary? Those people that have written it 2 times and those people that are writing a professional student. Can anybody help us out?
So I can help, I think.
Help. When you mention it, you will tell us those summary about that particular thing that you actually mentioned.
Yeah. Okay. So we have 5 components of financial statement. Number 1 is the statement of financial position, which comprises of your assets, of your liabilities, of your equity. And assets is divided into non-current assets and current assets. You know that one. Then we have statement of profit or loss or other comprehensive income, which is your OCI, which comprises of your income and your expenses. Then for your OCI, we have your evaluation of like properties, gain or loss. I can't remember, but then we also have statement of cash flow, which comprises of your operating activities, investing, and your financing activities. Then we have notes to the accounts, which are your additional information when preparing your accounts. And then we now have last one, statements of changes in equity, which deals with your share premium. Basically your equity in your statement of financial position is what you put in your statement changes of equity. So that is it, sir.
Very good. Who can help us again? Thank you, madam. I want to try again. Let me tell you this, please. In my class, I'm not a lecturer that maybe you made a mistake in a particular something. No. There is no wrong answer in my class. Yes, everybody is here to actually learn. Please don't feel shy. There is no wrong answer.
Leave the half. This girl taking him to school.
So please, like I said, who want to try again? There is no wrong answer. In my class, there is no wrong answer. Who want to try again? Component of financial statement. Who want to try? Who want to try? Do you want to try? Okay. Let me tell you something. You guys might not cannot do without standard IS1 this diet. Mark my word. I don't know, maybe it's going to be at the skill level. I don't know, or a professional. But you cannot do without IS1. IS1 will surely come this diet because it's more or less going gradually to an end. So IS1 might likely come this diet. So when they ask you a component of a financial statement, like Prince has actually summarized, you actually try. So let me just break it down. So for the complete set of financial statement, it must include statement of financial position. We can also call it a balance sheet. What is this one does? Statement of financial position show assets, liability, and equity at the end of the reporting period. Let me come again. Statement of financial position show assets, liability, and equity at the end of the reporting period. 2, statement of profit or loss and other comprehensive income. This will report profit or loss for the period. Other comprehensive income will include revaluation, surplus, actual gain or loss, fair value gain, and so on and so forth. Then set of changes in equity will show the equity movement, that is, movement in share capital, movement in retained earning, movement in reserved, movements in other comprehensive income items, and so forth and so forth. Then when you are talking about cash flow statement, the cash flow statement will show inflow and outflow from operating activities, investing activities, and financing activities. Then the last one is note to the account. Note to the account means more or less a disclosure or addition, that is accounting policy, supporting information, breakdown and explanation for line item, and so forth and so forth, and so forth and so on. That is what we call a component of financial statement. And let me now tell you this. For at your level, some of you may be asked, maybe when you go for interview, yes, at your level, you may be asked that what are the components of financial statements. This is even not even ICAN now. I'm not talking about ICAN. I'm not even talking about ACC, but I am telling you, in some cases at your level, if you want to do an interview for maybe a accounting job, they might ask you something like that. So that is just the summary about component of financial statement. Now, let's move to underlying assumptions in IS1. Underlying assumptions in IS1. Now, IS1 rely on 2 key assumptions. 1, accurate basis of accounting, and going concern. Please, who can help us the meaning of accurate basis of accounting and going concern? Who want to help us? Someone must help us. So, who want to help us, please? Hello? Who is there? Everybody is not talking. Oh yeah, talk. Say something. Say something. You raise up your hand. Oh yeah, talk. We can hear you. Clementina, we can hear you. We can hear you. Hello? Can someone hear? Okay. Nobody want to talk?
Good evening, sir.
Good evening.
Yeah, can I talk on going concern?
Anyone, either of the two.
Okay, sir. For going concern, can you hear me?
Very well.
It states that the financial statements are prepared on the assumption that the reporting entity is a going concern and that it will continue in operation for the foreseeable future.
Very good. Now help us with accurate basis.
Okay, sir. Good evening, sir. So
Good evening.
the accurate basis talked about that revenue should be recognized when earned and expenses should be recognized when incurred.
Okay. Sorry, ma. Come again, ma.
That revenue should be recognized when earned and expenses should be recognized when incurred.
Okay. Thank you. And whosoever that still want to try, you can still try.
Good evening,
The floor is
sir.
open. Good evening.
Yes, sir. I think the accrual basis talk about as in, the way business goes,
Yes.
payments are not made immediately when the goods are bought. So, but they are recorded as if the payment has been made. They are recorded at the point of payment, not they don't wait until the payment is made before being recorded, but they are recorded at that moment as if the payment has been made, even though the payment will be made in future time.
Very good. Thank you, man, for everybody. Any guy there, please, guy. I should not for my hand, though. Any guy
Okay,
there,
sir.
please.
Okay, hello, sir.
Yeah.
Can I try?
Yes, try. Bail us out, please.
Okay. To me, I can see that is when the company record, like when the company record revenue and expenses before money is being received or spent. Is that okay, sir?
Yes, it's okay.
Like to my own understanding, though.
Yes, it's fine.
Because
It's fine.
I don't use every other person definition.
It's fine. It's fine. So thank you. Everybody has spoken well. Very, very perfect and good. Very perfect and good. In addition to everybody, to what you have said, you're actually right. So let me just explain it in detail as well. So we're talking about accurate basis accounting. Like somebody said, it's a fundamental accounting principle under which transaction and events are recorded when they occur, not when cash is received or paid. So the accrual basis accounting actually ensure that income and expenses are matched to the period in which they are earned or incurred. So regardless of when cash is exchanged. Now, I obviously just leave out a cash basis. So I was expecting somebody to actually link the two, but I've also just left it that way. So, nobody mentioned about cash basis. So when we're talking about cash basis, the cash basis is when cash is received. You will have to do what? Recognize it immediately. Unlike accrual basis. Accrual basis does not concern about whether you have received cash or not. Once you have incurred that expenses, they will recognize it. Once you have earned that income, they will recognize it. Under the accrual basis, we'll be hearing about payable, we'll be hearing about receivable. But under the cash basis, nothing like that. Nothing like that. Nothing like receivable or payable under the what is it called? Under the cash basis. So when my brother was telling you, I'm very sure that might have tell you this. The conceptual framework for financial reporting also emphasize the accrual basis as part of the underlying assumption. Also supported by IS1 under the heading accrual basis of accounting. So this is what we are actually talking about. Now, the going concern, you guys also spoke well. Yes, you are also correct. The going concern assumption means that an entity is expected to continue operating for the foreseeable future. That is, it will not liquidate or significantly reduce its operation. Can I come again? So what I am talking about, what I'm saying about going concern assumption is mean that an entity is expected to continue operating for the foreseeable future. That is, it will not liquidate or significantly reduce its operation. So under this principle, financial statements are prepared on the assumptions that the company A or B will remain in business and be able to realize its assets and settle its liability in the normal course of business. In the normal course of business. This is what we call a going concern and accrual basis of accounting. So when I want to share my own notes, I will include the cash basis. You need the knowledge. You cannot do without that because there are some parastatal, there are some government agencies that are using cash basis. That is, yes, they actually deal with cash basis. Though it has its own limitation, yes, a lot of limitation. Because if care is not taken, if you are using a cash basis, the possibility of you losing money is very high. Yes, it's very high. It's very, very high, unlike accrual basis. So once you have earned the income, you will recognize it, whether you have received the money or not. But or if you have incurred the expenses, you recognize it, whether you make payment or not. Unlike a cash basis, that we have to make payment for me to recognize the expenses, or I must receive cash for the goods that I sold out for me to recognize the expenses. So these are the things that we also need to know. Now let's move on to quantitative characteristic of financial statement. So these are the four that we have. We have understandable, we have relevant, we have reliable, we have comparability. Anyone that you understand there, please, can you help us to explain it or summarize it? Anybody in the house? Why I am asking you, I suppose to just explain and move on. No, I want it to actually stick to your own knowledge. Yes, I want you to actually stick to your own knowledge. That is why I'm asking you all this. So if you don't understand it, no cause for alarm. That is why we are here. So, but if you understand any of this, let us know, please. You can just help us out.
Good. Comparability. Can I go ahead,
Yes.
sir?
Go ahead.
Okay, that's comparable. That's comparing two different companies in the same industry with each other, with their comparing them, maybe the performance of two companies in the same industry, or comparing the performance of a particular company, this in a current year with the previous year, to see their performance. If they are actually doing well or not doing well, then the necessary actions will be taken. Thank you, sir.
Very good. Very good. Any other person want to help?
Good evening.
Good evening.
Hello, can you hear me?
Yes, I can hear you.
All right. Talking about understandable. A good account statement must be understandable, even if non-accounting students get to take note of the account. You need to understand that, oh, this is what he said, this is what he said. It must be understood by everyone. I'm talking about relevant. Am I with you, sir?
Go ahead.
All right, sir. Talking about relevant, it must be relevant with the current accounting principles. It must be based on principles, the laid down principles regarding the accounting. Then it must be reliable. That is talking about the intended aspect of it, must be reliable. Then, just like my sister said earlier, comparability. While checking it with other company statements, the principle used must be the same. Not that you'll be using ACRA or the normal procedure of preparing it is different from other company owns. I think that is that about that, sir. Thank you.
Very good. Thank you, sir.
Hello, sir.
Hello, sir.
Yes, go ahead.
Can I add something to the relevant?
Yes. Add it.
Okay, for an information to be relevant, it has to have two important things. Like it has to be predictive and conformity.
Very good. Yes, that is the right word. Predictive and conformity. Yes, comparative value. Yes. So also anybody who still want to help us? Anybody who want to help us? Favor, I'm not here about. She's not even there today. Favor. Okay. Because of the time, I don't want us to waste much time. By 9:30, we should close or before the 9:30. So the quantitative characteristic of financial statements, people have explained it very well, very good. So I will not explain that relevancy again because that woman have already done it justice. However, if you want to write it down, maybe I should add it before I send this note.
Sir, the comparability. I think you must able to compare let's say 2024 to 2023. Yes. You must able to compare. That's comparability.
Yes.
The first year and the
last
year. Yes, you must able to compare. Yes. Maybe the performance. The area where I want to ask a question in this area is that when we say comparability, now there you know that because I prepare one account to one company, to one bank, to one company, and that company now send that account to a bank for facility. Now they now said there must be ratio. That is the performance of the first year and the second year.
Yes,
I need to
I
need to indicate it. I need to indicate it. So but in this the topic that we are teaching now, there is nothing like that is a ratio. It's a ratio analysis, but it must be mentioned. It's supposed to be mentioned in that in this topic.
Okay.
Because to show that this thing have not completed. Because in fact they reject that account from that. I should go and test the ratio of the first year and the second year before they can accept the account from me.
Okay.
And it has not been mentioned.
Okay.
In this topic.
Yes. Let me tell you something. The comparability that you have said, I've already mentioned it. When you are comparing, let me tell you something. When you prepare a financial statement, and you should be able to actually compare it with the previous year. As an accountant, as a good accountant, you have to be very smart to the extent of even giving them the historical analysis. That is, you be able to compute at least a relevant ratio to show changes. Yes, they want to see changes. Yes, changes, percentage changes. Yes. That is why they are asking you that you should go back and include a ratio. They want to see what a percentage changes between last year and this year. That's it.
But it's supposed to. But in this questions, they're supposed to mention ratio analysis, and it has not been. And they didn't mention it.
They will not mention it. They will not. From your. Let me tell you something. Now, when you are talking about a comparability, what you are saying is that I may not even do financial for anybody. I may not show figure. I will just decided to show my ratio of last year compared to ratio of this year. Let me tell you something. If you send an account to me and you just put in your performance, you don't give me what is it called? Revenue. You don't give me expenses or some other thing. You just send me a ratio. I already know the year that actually performed well than the other year. That is what we call a comparability. However, let me tell you something. You have already moved me to ratio aspect, which is also my own area. Now, ratio is only good when you have something to compare with. Yes. Let me tell you something. If a company starts a business in the first year, ratio is valueless in the company because nothing to compare it with. So the ratio is only good when you can compare it with other years or when you can compare it with other industry. So the ratio as well has its own limitation. I will not say it now. When we get to that level, I'll be telling you more. Though you might have heard about all those our ratio. But because of what you are saying now, that we don't mention ratio directly or indirectly, the comparability is talking about you should include your own ratio. That is, you are comparing the performance of last year with the performance of this year. Somebody want to talk? Go ahead. Abayomi.
Okay,
Go ahead.
good evening, everyone. Good evening, everybody.
Yes.
I just want to buttress what you said, sir. I believe that comparability has already included ratio because there's no way you can do comparable without ratio analysis.
Ratio. Very good.
Ratio analysis. So just like you have said, sir,
yes,
it is already in there.
It's already
Thank
there.
You, sir.
It's already embedded in that a comparability. So what we are just speaking here is grammar, that you should compare last year with this year, without even telling you that you should use ratio. It's there already. That is it.
Thank you. Okay, we can move forward.
Okay, thank you, sir. Any other person? So from these four that I mentioned, which one that is missing?
No, nothing, sir.
We have vulnerability. Vulnerability is not there. Timeless is not there.
Timeless, yes. No,
all
sir.
Those one is not there.
So you have to mean that the company have timeless. You have to presentations of the accounting information at the right time.
Yes,
as when due, so that the company will make use of the information at when due for other purpose, for their own purpose. Yes. And not only that,
it's for decision making.
For decision making. For example, at least if you prepare the account at July, means that you are going to pay later penalty. So you have to prepare and meet deadline. So presentations of the financial statement are when due.
Very good. Thank you, sir. So let me just summarize it because of the time. So relevancy, like everybody have said, that word only, I've already explained himself. That is, information is relevant if it can influence user decision. I hope you guys know all these users. Okay.
Sir, can you please expatiate between this relevant and comparable?
I will do it. Okay. I will do it. Sure. I will do it. So relevancy. The relevancy means that information is relevant if it can influence users' decision. That is, like that woman said, which will include predictive and the confirmatory value. Like all this materiality. Yes, is an aspect of relevance, which information is material, or if omitting, it could affect decision making. That is what we call irrelevant. Any information that can influence the decision of users. Who are those users? Who are the users of financial statement? Let me even ask. Who are the users?
Government.
Internal and external users.
Government. Stakeholder. Management.
Employee,
and all
General
those
public.
like that.
The local communities too.
Joy. Joy, can you talk? Okay.
Joy, talk.
She cannot talk. I think she is cooking. By this time, I know.
Good evening.
Are you not cooking?
Good evening, sir. Good evening, sir. Yes, sir.
Good evening. Are you not cooking today?
since my boss,
Okay.
my Oga, you know that
Yes.
I came late to the exam, and they gave me 38 in the exam. I don't know. I don't know why I got 38. In fact, I don't even expect that I will score. That I think that I'm going to score more than 38, and but
Okay.
in fact,
You have to put more effort. So, you know, they've changed the syllabus now. Their eyes is red now, so you have to put more effort. They will not laugh with you again for this diet. So you just have to put more effort. Just follow all the classes. Read your own book as well. So please and please. You actually try with that mark, you actually try. You actually try. So now I was thinking about the users of financial statement. Everybody are mentioning shareholder, management, staff, government, and some other thing. I just said, who are the users of financial statement? That is what I am asking first. I don't say we should mention all those things. Who are the users? Except one person or two.
Internal user and external.
Internal and external users.
So when they ask you a question, except if they specify it, first of all, mention external and internal. So under the external, you mention all those your governments, all those financial institutions, and so on and so forth. Then under the internal, then you mention it. That is how to answer professionally. Yes. Don't just be mentioning all those things, except if they specify it that okay, the users of financial statement are external and internal. Please specify all those people. That one is different. So that just it. Please take note of that one. So let me go to comparability. The comparability means users should be able to compare information across period between entities, or also require consistency in accounting policy and presentation, which is also include your own ratio analysis. The one that you are saying includes a ratio. Please, when you want to compare a financial statement from one industry to another, or you want to compare it period by period, like last year to this year. So the next one is understandability. Okay, understandability means information should be clear and concise without oversimplify. Yes, it should be clear enough. The any information that you want to present in your financial statement should be very clear and concise. Don't use any word that is not permitted in the accounting standard. So users are assumed to have reasonable knowledge of business and accounting. Now that I present a financial statement, my management cannot understand it. That is not a good understanding of financial statement. So the financial statement should be understandable, or should be very well understandable. Yes, very clear enough that everybody will be able to understand it. Even to the non-accountant, should be able to understand it. Something happened recently. I left a particular company for another one. So the MD where I left is in UK. So he has a business in UK and he wants to collect loan. Somebody helped him to actually prepare a financial statement. In UK, the bank rejected it, that they should include something. He now sent it to me. Though I've left his company, but he knows that I understand it very well. So when I prepared it, it's not an accountant. So this man is not an accountant. He's a business guru. He's a very rich guy. So when I sent it to him, so he said that even him that is not an accountant, he understands it better. So that is what we are actually saying, that when you prepare a financial statement, non-accountant should be able to interpret it. You must simplify it for people to understand it very well. So I did not mention timeliness. Timeliness is part of this aspect. The timeliness means information must be provided in time to influence decision making. Now, let's use financial reporting as an example. You know, June is the last month that you must file your account with the government. Now, let us assume that you just finish your own financial statement in July. Now, I want to tell you, is that timeline, or timeliness, or what?
It's not timeless now. It has affected the.
Because
it has already affected
yes,
the company with 25,000 naira.
Yes, with the charges.
Yes.
With the charges. So let me now break it down again. Yes, let me now break it down again. You used to submit a particular report, maybe performance, every Monday. And this performance is being used by the management for them to take a decision every Monday. So I'm getting to the meeting, you're not giving excuses. You delay them, you say, by a Tuesday, you present it. However, you are able to actually present it on Tuesday. But Monday is the time for them to take a decision. But you actually present that report on Tuesday. So is that timeliness or not?
Untimeliness.
Yes, it's already failed. It's already failed that time. So those are the things that we're talking about the quantitative characteristic of financial statement. So let me run through this.
Okay,
which one is talking about?
I want to ask a question, sir.
Okay.
You know that in the season whereby you prepare an account, and the management now asks you the auditor to come and interpret the accounting statement to them. What you have complete, they want you to come and interpret the accounting statement to the management. Now, we said that you need to prepare the accounting for everybody to understand. What of if because I've seen a source that where we prepare the account and they now say, okay, the management should now, the auditor should now come to interpret the accounting statement, what he has computed to the management. So, we prepare the account in a simple way that everybody can understand, but they cannot understand it until when we come and interpret the accounting statement for the management to understand. Are we saying that it is not everybody that can pick the financial statement and understand it?
Okay.
That is where I'm coming.
That's an accountant prepare a financial statement, Abi?
Yes. The auditor prepare an accounting statement, prepare a financial statement.
Come
and
again,
they now say, okay.
Auditor.
The auditor. Yes, sir.
Account statement. Auditor don't prepare account statement.
Auditor don't prepare financial statement.
Auditor don't prepare, you only audit it.
Yes.
Yes, wait. I understand where you are going. Because I've seen okay, when accountant prepare an accounting prepare an account, and the now auditor now come and check it and set an opinion on the financial statement that the accountant prepare. Number one. Now, after preparation of the account, they will now ask you. They will now ask the auditor to come and interpret the financial statement to the management. And I'm now with what you are saying now, that we must prepare the account for everybody to understand, to pick and understand. Why the management now asking auditor to come and interpret
Okay. Let me ask you, let me tell you something. Let me answer your question. Two things apply in that place. Two things. The number one thing, it might be lack of trust. That is number one to the accountant. Number two, the management might want external opinion, independent opinion. That the accountant and the management, their staffs, employee of that the company, but external auditor is not. So it's an independent person. They actually believe that, okay, in his interpretation, it will not put bias. But if it is an accountant, they may be thinking that accountants may be putting bias based on his own selfish interest. Maybe that is why they ask the auditor to come and interpret it. One, like I said, lack of trust, or the management may want independent opinion that is different from their own staffs. So that is the only reason that they can ask. That is what actually happened. That is it. That is what actually happened.
Sir, please, can I contribute?
Yes, go ahead.
Okay, from where he was coming from, he said, since we prepare financial statements so that it will be understandable, what is the need of interpreting the financial statement again? That is what he's asking. Hello, guys. Shay, that is what you're asking, right?
Yes.
Okay.
Good.
Yes, thank you.
Sir, can I talk? I think one of the responsibilities of an accountant is also to, when you prepare a financial statement, is to interpret it. So I think that following due process in that case.
Yes, is to interpret it. So what management wants at that aspect is not that they don't understand it. Like, let me tell you this. Let me use this as an example. Now, in your company, the shareholder have already said, okay, if we can sell 100 billion at the end of this year, that is going to be pay rise, that is salary increase and bonuses at the end of the year. Or the management has said, if you can make a 50 billion profit at the end of this year, that will be bonuses, that will be allowances for everybody. And they asked me to actually prepare the financial statement as an accountant. I'll be working based on that 50 billion, that target, that once we hit that target, then I have my own bonus and allowances. Let's now assume that maybe our profit is just 58 billion. So remain maybe 2 billion for me to cross to that, to that target. As an accountant, some people might reduce expenses for them to get to that target. But in this case now, management, and in this case, if they want me again, I'm the one that actually prepared it, and they still call me again to come and present it to them, it's going to be more or less garbage in, garbage out. I've already know the base that I cook under that financial statement. Hello, is someone talking?
Hello. No, continue. Yes, continue, sir.
Okay, so the management may decide, okay, accountants has prepared the financial statement, is well understood, but we need external opinion. We need an independent opinion to come and interpret it for us. That is what happened. Yes, it's not that they don't. Yes, that is what happened. There are many accountants, something we call creative accounting. Yes.
Sir, with my relationship with work that I'm doing, I've seen some accountants who does not even know anything. That could you believe that FCCA, that we audited their accounts, and FCCA he lost when we get to his stage. The man lost FCCA, fellow, FCCA, not ACA, not ACO. He lost. He cannot even go forward again until when we need to engage. We need to engage ACCA. We need to engage somebody who is fellow to come and do the account. So I look at it that we cannot. The man does not even prepare the account. We are the one that prepare the account and audited the account again. And it's a big company, which I cannot even mention here. Big company that have about 10 to 20 billion turnover.
Okay.
I want to tell you.
Let me tell you something. Let me tell you something. Be a chartered accountant or FCA does not guarantee you to know how to prepare financial statement. No. It does not. I don't want to mention a company. You know, we have a specialization. Some people have a specialization. There are some people that they have not been asked to actually prepare financial statement in their own life. And they are accountants, FCA. So they have their own specialization. Yes. A particular person, a general manager in a big organization, an FCA, he had accounts and finance. It's not the one preparing the financial statement. It's not the one. So be an accountant or FCA, ICA member, ACCA member, CPA, and so on and so forth does not guarantee you to know how to prepare financial statements. So that does it. Don't blame, it's an FCA. No. Don't say that. When I join any company, if I meet a lot of accountants, like where I'm co-working, I have lots of accountants. We are more than, in the group, we are more than like 30 something an accountant. And I don't look down on anybody. Maybe they can prepare financial statement or not. No, I don't mind. The only thing is that what I am there to do is to defend my own, responsibility. Whatever the job that they ask me to actually do, I will go there and do it. Now, they actually take me to a subsidiary to assist them in financial statement. A colleague of mine who has been working with them for more than 5 years, a senior accountant cannot use Excel, talk less of even preparing financial statement. I'm just telling you this. Yes, not even preparing financial statement, use Excel to arrange some reports. So you can't just say because it's an accountant, he must know how to prepare financial statement. No. So that just it. Let's take that mind from our own mind. What of those people who are working with government? What of those people who are working with government who have not even seen financial statement in their own life and they are the directors? Yes. So that is it. You can't say because this. No. That does it. That does it. So let us continue what we are doing. Let us actually continue. ICANN or ACCA will not teach you on how to prepare. They will just guide you. Like now, this standard is guiding us on how to prepare financial statement. It may not give you that practical. So what you are telling you, use this knowledge when you are preparing your financial statement. All this knowledge that you have in IS1, go and use it and prepare your financial statement. That is what a professional is telling you. Not, I want to teach you on how to prepare financial statement. No. So, like I said, I want to stop by 9:30 because of the time. So now, let's explain this fair presentation, materiality, offsetting, consistency of presentation. Any idea? Any idea? Just pick anyone.
I have an idea of materiality, sir.
Oh yeah.
Okay, the concept of materiality states that omission of an item, if it will affect the decision of the end users or users of account, is material. The omission of an item in the financial statement is material if it affects the users of the financial statement. I think, yeah.
Okay. Any other person? Thank you.
Okay, consistency. Consistency talks about that an organization should be consistent in their accounting method. Like if they are using this accounting method, they should be consistent. Not that this year they are using this method and next year they are using this method.
So because of the time, thank you, ma. So this consistency, I'm going to remind you something. You know, this is IS1, right? When we get to IS8, IS16, and which other standard again? I will refer you back to IS1 that you should remember about this inconsistency. So this is IS8. I mean, this is IS1, sorry. That is why I said IS1 is the bedrock of other standard. So now, fair presentation. It means that information must represent what its purpose to represent. The purpose of that, what is it called? Financial statement. It must represent it. That is neutral, free from bias, free from error. That is no materiality, no material mistake or omission. No material mistake or omission. That is faith presentation. That is faith presentation. Then they were talking about materiality. An auditor cherish this aspect, materiality. They cherish materiality, yes, because that is one of their, even if they want to give an opinion on a particular item in a financial statement, they will test the materiality of that item. So materiality actually refers to the importance or significance of information in financial statement. So like an item is material if omitting, misstating, or obscuring it could influence the decision of financial users or users of accounts. So there are some key points that you should know about materiality, like size or nature. You should also understand judgment-based concept on that materiality. When an auditor go for an audit work, 2 million may not be material to them, yes, in an expenses. It depends on the voluminous, it depends on the turnover of a particular company. Let's assume that your turnover in a year is trillion. So you are looking for 2 million. Auditor will not use that one as just to qualify the account. No, they will never, because 2 million to what we are here for is not material. And in some cases, 2 million may be material. Maybe your income at the end of the year is just a 20 million. Even 500,000 will be material to such organization. So materiality, yes, yes.
Even 1,000 naira.
Yes, materiality is based on the judgment. Yes, it's based on the.
So, sir, does it now mean that it depends on the size of the business for an item to be material?
Now,
yes.
Let me flash back to 2014, 2015, 2016. I was doing one audit work then. So we went for a particular engagement in a big hospital, federal government hospital. Okay, Bobby, let me just say Bobby here. Yes, in Lagos here. So I was still new that period. So the man that led us to that place, so just gives some of us that should be auditing bank charges. He gives some, they will be doing assets, give some other expenses. Do you know what happened? The head of finance in that place just he saw us auditing bank charges, all this CI, all this COT. The man was now, where is the audit manager? Our guys is there. Say, with what you are here for, you are auditing bank charges. Is that mean that you want to be here for life, Abby? or what? So to them, all these bank charges is not material. Yes, it's not material. So like I said, materiality is depend on the size or nature of the event.
The size of the company.
Yes.
Let me give you another sample, sir. One of my boss took me to one company when I got there. So they now asked me to be dealing with the asset register. You know that there are some expenses that they incur to bring the asset to the company. Some like 20,000. They say ignore that one. They ask me ignore that one. I was asking my boss that 20,000 is transport. They say I beg ignore it. We are talking of million. You are not talking of 20,000, 50,000. I beg ignore that one. So I want to add that transportation to the asset. They say, Mr. Yinka, leave that one, please. We are talking of millions.
It's not material.
It's not relevant to them. It's not material to them.
It's not. So that is it. It's not. It's not relevant to them. So now let's talk about offsetting. Offsetting is not allowed unless permitted. Offsetting is not allowed unless permitted. We still talk more about this under IS 12 and IFRS 9, I think so. So offsetting actually means netting an asset against a liability or income against an expenses and showing the net amount in the financial statement. So in IS1 rule, offsetting is not allowed unless it is required or permitted by a specific standard like IAS or IFRS. Second, it results in a faithful representation. So offsetting is not allowed. Let me also say this. You know, in a layman language, maybe I'm owing somebody a 20,000 naira, and the person is also owing me a 25,000. So from our own general knowledge now, that let's net it off. Shebi, I'm owing you a 20,000 and you are also owing me a 25,000. So let's net it off and show the balance as 5,000. IS1 prohibits offsetting this kind of a transaction. What we are saying is that the management or the users, yes, let me use users, of financial statement need to know how you arrive at your income, each incomes in your financial statement. Then they want to see the breakdown of the expenses. Now you can now compare it. Not that, okay, let's just assume our total income for this year is 10 million, and our total expenses for this year is 8 million. You know, 8 minus 10 is actually 2, abi? So you don't do that one and put it in your financial statement. No, they want to see how you make that income of 10 million and how you incur expenses of 8 million for you to have arrived at that 2 million. That is what IS1 is talking about. But for you to be saying, I have a 10 million, then I also incur 8 million, then let me let it up. No, it's not permitted under IS1. Under IS1, and it has given you a condition. The only condition that you can let it off is if it is required or permitted by standard, or it will result in a faithful representation. That is the only area that you can let it off, in which no standard permitted that one. Even IS12, you know, we have deferred income, deferred tax and deferred liability. Deferred tax and deferred liability also give a condition, and they also refer you to IS1, that IS1 does not condone with all this offsetting. It prohibits the offsetting. So please just have it at the back of your mind. If they are asking you in your exam, before I first state it, the meaning of offsetting, then tell them the rule behind IS1 for you to offset an asset with expenses, or income with expenses, or asset with a liability, which is two, it must require or permitted by standard, or if the presentation will be, what is it called? If the result we actually give a good opinion or faithful representation, that is the only area that you can net it off. So that is just it. So for the consistency means that the presentation and the classification of item in the financial statement should be the same from one period to another. So IS8, a change is required by a new IFRS. That is, for you to actually change like a policy, yes. When we get to IS8, we'll be talking about a policy. You cannot just change a policy in the company. You cannot. It must back up with a standard or other, other condition. You must be consistent. Like if you are using, hold on, I'm coming. If you are using, depreciation. If you want to depreciate, what is the name? This depreciation, please remind me.
Straight line method.
Straight line method, good, thank you. If you are using a straight line method, you must be consistent. You cannot just change from a straight line method to a decreasing balance. Or if you are using IS16 measurements, who can help us with that one? 2, cost measurement and revaluation measurement. Any one that you are using, if it is cost, you must stick to that one. And if it is a revaluation, you must stick to that one, except if this is permitted by other standard or IFRS. So you want to say something?
Sir, it is in the situation whereby the company changed the accountant, and the accountant now said, okay, this what the way the former accountant was doing this accounting, so we need to change it. So is it possible for them to change the way the policy? Yes, sir.
No. Accountant cannot change a policy. Even though you are talking about assets, these are the assets, so we have to revalue it. You should not be the one that will evaluate. We have a professional valuers. They are outside there. So let them give their own opinion. So that one is actually permitted. You should not be the one as an accountant that you want to evaluate on your own and put it in your financial statement. Auditor will throw it away. Yes, auditor will never accept that. It will throw it away. So that is what we are saying.
Okay, sir. Okay, sir.
Any other question? Any question? We are getting to the end of the class, so any question, please.
So I do have a question, sir. I want to under offsetting. So can you hear me?
Yes.
So basically, if a company wants to purchase something, maybe a car or something from a company, and then a company needs maybe the same. Can you like use your assets to pay for the, like, you get what I mean? Like maybe you're selling like maybe cables or something, and then they need it, do you get? And can you use the cables, what's that amount to exchange for the car?
Like a collateral. Or like trade by barter. Use what you have to get what you want.
Trade by barter, not collateral.
Sorry, trade by barter.
Come again. Please.
So like, is it allowed that a company can use their own assets to get another asset? Basically, like maybe they want to purchase a car, and then what, maybe like 50 million or something, or let's say 2 million, let's say 2 million, and they have and the company needs that maybe a cable that they are selling. Can you like sell that can you sell your cable worth that 2 million to them Is it allowed? Like
what you are saying is outside the scope of IS1. What you are saying now practically is this business aspect. Yes, that one is actually business. Like
It's different from offsetting.
It's actually different from offsetting.
Offsetting.
It's different from the scope of IS1. So IS1, what IS1 is just talking about is that in your financial statement, you must show the detail of the income, then show the detail of the expenses. So let the users of the financial statement, let them see it. Also, in your assets, you must show the detail of your assets and also show the detail of your liability. Not that my total asset minus this thing, I will just summarize it and net it off. No. So what you are saying is just a business perspective, not in the scope of IS1.
Okay, no problem.
Yeah,
Thank you.
Yeah. Any other question? We are getting to the end of the class. So, any other question?
No, sir.
Any question from the house?
Yes.
Go ahead.
Okay, I want to ask for this offsetting. Is it more like, for example, where you have a business like the same company, but maybe company A and company B, and then transactions between them, it could, like maybe company A bought from company B, you cannot offset based on that.
Company A, I like it. It's a question. Yeah, go ahead.
Like company A purchased from company B.
Okay.
They are all under the same
umbrella.
Owner, but different
entity.
Maybe wire entity and maybe wiring and coupling, something like that.
I understand all your answer is
so
there.
Transactions between these companies cannot offset when reporting or presenting your financial statement. Is that it? Is it possible?
Okay. Any Bayland students who want
Yes,
to help us?
Let me see if I can assist.
It's very easy. Any Bayland students?
So let me see if I can assist together.
Okay. Go ahead. We can hear you. Hello. Can someone hear him?
We cannot hear him, sir.
No, sir.
Okay. I want to try again.
Hello, good evening, sir.
Good evening.
Yes. I think.
Hello, can you hear me?
Very well.
Okay, I think the offsetting, the question here is that you should not net whatsoever you want to do in and display a unit amount in your financial statement, but rather what you should do is that it should be properly declared. So, for example, like the explanation, there's a question that someone just asked about wanting to buy a car and you have to get a rope, a wire. You should not just say this minus this and net it and offset it and carry that single amount and just go and put in your books, but rather you should declare and say, okay, you have an asset, then you do a disposal of assets. And I don't know if you get what I'm trying to say. So your books should be clearly, your book should be clearly stating, and it should be what's the word? Transparent enough to show the activities or operation of that transaction, not that you just net off and just say 3,000 minus 2,000 and just carry 1,000 and go and put in your book. That's practically offsetting, and that is not allowed. That's what I think, sir.
Sir, thank you very much, Mr. Ogunsona. I want to this offsetting of a thing. Hello, sir. Are you listening to me, sir?
Very well.
Okay. This offsetting of a thing, because I want to understand, because it came out in our examination. for this this offsetting. Are we saying that when we are talking about, let's say we have a turnover of 1 million naira and we have expenses of 500,000, we now minus expense in 500 from 1 million, making 500. We now put 500,000 as turnover. Are we talking? Is it what we are talking
It's
about?
not permitted.
Offsetting.
It's not permitted. What IS1 is talking about, you have to show it separately. Yes, you have to show it separately. You show it.
Is that what we are talking about of offsetting? Because in this question of a thing of offsetting came out in May exam. Is that what we are talking? Is that what we are talking about?
Yes. Let me tell you again. Like I told you, you are owing somebody. You are owing somebody 100,000, and 2 months later, the person is owing you 120. You know, 120 minus 100 is 20, Abi. So from
Yes,
your
sir.
own financial statement, you will not state it how you arrive at that 20. You don't say 120 minus 100, and you say it's 20, without really showing it that so person is owing me a so particular amount, and as well I'm owing a so particular amount. So you have to. That is why we have notes to the account that we show the detail of what actually what actually happened during the reporting period. You can't net off your expenses from your income, and you cannot as well net off your assets from your liability. You have to show it separately. Now, back to that, madam.
Okay.
Gifts.
Sir?
I can't pronounce that your first name.
Itariable.
Huh?
Itariable or Itaria for short.
Itaria.
Where
are you from?
Praise,
Itaria.
my lecturer.
Itaria.
Where are you from?
Rivers State.
Okay. Thank you. So now, based on what you just asked, you are writing ski, Abi?
No, sir, professional.
Oh, okay. Even though you are not our student, I expect our students to actually answer you. Yes, I expect them. I expect our students to use group accounts to answer you, but none of them actually saying it. I expect our students to use a group account to answer you, but none of them answer able to say anything. Now, what you are saying, you are going to a group account. Yes, you are going to a group account. I'm very sure that Mr. Michael have taught you guys all this thing. So, what happened is intercompany transaction, and in group account, intercompany trading is not what? It's actually what is it called? You have to remove it. Yes. What we are saying is that in a group of accounts, like we have group, subsidiary A, B, C, and D. Subsidiary A buy from a subsidiary B, and subsidiary C sell to a subsidiary A. So you are now saying that we should net it off. Whether you let it off or not, at the end of the reporting year, you know, when you are doing a consolidation, one entity we actually record a payable, and the other entity will record a receivable. So it will amount to a 0 naira. That is 2 minus 2. It will be a 0. That is, an entity A recognize it as payable, 2 million. Entity B recognize it as receivable, 2 million. When you are doing a consolidation at the end of the financial year, it will be 0. It will not have any impact in the financial statement.
Okay.
So it's different from net off. It's different from net off.
Okay.
Yes, it's different from net off.
Thank you, sir.
Yeah, thank you. Any other question?
No more questions. You can give us a assignment.
Yes, question, sir. There's
No,
question.
sorry, there's question. There is question,
There's
sorry.
question.
Okay.
Your last statement, sir, you said is different from net off. Please, what was net off? Because I just joined not quite long. So what's down net off on its own? Since you said intercompany transaction that should be netted off, it's different from net off. So what is net off on its own?
Okay. Can somebody help me with that net off? Anybody? Our
I
students,
think it's
anybody?
when receivable and payable amount to when they net off each other and then it amounts to 0, something like that.
Okay. Yeah. Net off now, where that or guy what want to hear is that you are subtracting one amount from another and reporting only the net figure in the financial statement instead of showing each item separately. That is what we call net off. And IS1 prohibits that. Because one, it will not give a true picture of the whole financial statement. Yes, the users of financial statement, the investors, they want to see it clearly. They want to see your income. We break it down. How you arrive, okay, well, I show it in my financial statement that at the end of the year, we make 100 billion. I just summarize it. I said we make 100 billion without detail on how we arrive on that 100 billion. Or in our expenses, I just show that we also incur, 80 billion expenses without even showing it. That is net off. That is net off. That is subtracting one amount from another and reporting it only on the net figure in the financial statement instead of showing each item. Instead of showing each item. That is net off. So it's different from subsidiary one, A, sell or buy from a subsidiary B. That one is actually different. It's different. It's different. So
okay,
what
sir.
that woman is asking is they're talking about group accounts. I'm very sure when you start your own group with us here, you will get to understand it better. You get to understand it better.
Yeah. It's clear. Thank you, sir.
Yeah, thank you.
You're welcome, sir.
Any other question before we call it today?
Yes. Good evening, sir.
No question.
Yes, question.
Yeah,
There's
answer
question.
this.
There's question.
Okay, you have question.
My question, though I joined very late. You're most handed up before I joined. I slept off. Sorry. So, but the question I just want to ask now, you in the course of a explanation about intercompany or group trading or something.
My network is breaking. Is it your network or my network?
I don't know. Sorry. Hello, can you hear me, sir? Can you hear me? Hello.
Can someone hear him and help us out?
Yeah, sure. You can hear him. You can hear both of you.
Can hear him.
Okay.
Oh, okay. Thank
Yes.
you. So I just need a clarification between.
I can hear you.
Yes, sir. I need a clarification.
Yes, we can hear you.
Yeah, I'm with you, sir. So I need a clarification between this intercompany trading because you said that something is not allowed between intercompany trading. But I remember that in PM we have something we call transfer pricing, interdenominational, interdivisional trading or something like that. Sir. That's division. So I just need a clarification between divisional trading, as in PM, PM divisional trading, transfer pricing.
I did not say it's not allowed. I did not say it is not allowed.
So.
That's right.
More.
Sir?
That's why.
Hello.
Please, so let's mute our mic. Let's mute our mic. Some people's mic is on. Please, let's mute our mic, please.
So, sir, I just need a clarification between intergroup trading and this PM. Hello, sir. Hello, can you hear me, sir? Oh, okay. All right, sir.
Network.
Okay.
Yeah, let's
Okay.
go because of my
Okay,
network.
so what I was trying to ask, that I just need a clarification. In the course of your explanation, you said intergroup trading or something is not allowed in the area. So I just need clarification in that aspect, and also in line with PM transfer pricing, divisional trading or something like that. So I just need a clarification between
Okay.
I think yes, I need a clarification.
I
sir.
did not
Thank
say
you.
I did not say intercompany transfer. I did not say intercompany trading is not allowed. I did not say that. I only said that offsetting is not allowed in what is it called in your financial statement. And I said that woman that was asking about maybe from one entity to another within a group of accounts, and I said that is a group of accounts which is going to be intercompany transaction or trading. And I said at the end of the year, it will not have any impact because one entity will record the payable and the other entity will record the receivable. So when you are doing the consolidation, it will be a zero. That is what I said. So in the area of, you asked about transfer pricing, Abi, is it transfer pricing?
Yes, and also divisional trading and all
now, when we're talking about a transfer pricing, so it's actually referred to the price at which goods or services or intangible assets are traded and transferred between related entity within same group or a multinational enterprise. So what we are saying, yes, what we are saying is that in transfer pricing, you transfer in goods and services between a multinational company in the same group of company. That is, like I said, if let us assume that I own a company and I have a subsidiary like 5. So if my what is it called? A subsidiary A buy from B or C sell to D and so on and so forth. That is what we call intercompany what is it called? Trading. Yes, intercompany trading. All these things that we are buying, whether we pay or not, when we want to consolidate our financial statement, it will not have any impact in our financial statement. It will never have any impact in our financial statement. So it's different from offsetting. Offsetting means that, like I said, you are subtracting one amount from another and show only net effect without showing the total separately. I mean, without showing the item separately. That is what we're talking about in IS1, which is not permitted.
Okay. So,
sorry.
Okay. Yeah. So, in summary, well, you must fully disclose what happened before we arrive at that net amount.
You cannot even.
I said
you cannot even net it off. That's what I'm saying. You cannot net it off. It's not permitted. Not even. This is different from even disclosure. You can't disclose. You cannot net it off. It's not permitted. And there is a condition for you to actually net it off. If other IAS or IFRS permitted it, then you can net it off. And I am telling you, other standard did not permit it. Other standards are also referring to IS1. That since IS1 did not permit netting off of asset with liability or expenses with income, we cannot permit as well this our own standard. When we get to IS 12, we talk about this net off. Then when we talk about IFRS 9, Abi, yes, I think it's IFRS 9. We also talk about this netting off. Those standards did not permit offsetting.
Thank you, sir.
Somebody wants to talk. Somebody wants to talk.
Hello.
In the absence, okay, you want
Hello,
to say
sir.
something?
Hello, sir.
Yes, yes.
Please, sir, I just want to make a request that you send the notes earlier before each class to the group.
I will do that tomorrow.
Okay, thank you, sir.
Yeah, me.
Then please, sir, please
It's a
also
must.
can we get the video recording of this class because of us that we've joined late. I actually joined very very late.
It's also tomorrow as well.
Oh, thank you,
Tomorrow
sir.
as well.
Thank you.
Tomorrow, definitely.
Okay, Mr. Pius, good evening, sir.
Could you please help us inform the
Please, I have a
other FR
question.
to also send the
bros.
full video?
I have a question.
Hello, sir. Hello, sir.
Brother.
Yes, sir. Oh, I think someone is speaking.
We can't hear
Sorry.
you.
Yeah. Can you hear me now?
Yeah.
I said we are also expecting the video record of the lecture we had on
Okay, yes.
on Tuesday for FR. The group accounting, the guy had not sent it. Please.
You said what?
The FR group accounting that we had
The guy
on.
that take FRB?
Yes, he hadn't sent the video lecture.
Michael, I think it's Michael. Okay.
Yes, it's Mr. Michael. Yes. Thank you, sir.
I will tell him.
Thank you, sir.
I will tell him. He will send it. Sorry for that. He's going to send it. He ought to have done that self. I don't know why. He's going to send it.
Mr. Pius.
Yes, bros. Scorer.
I have a question.
You don't start.
I hope my background is not too noisy.
Eh?
I have a question.
Oh, yeah, ask. Because of the time and my laptop is...
Okay, sorry, sir. My question is, are we treating... because the last guy that asked the question, so my thought was maybe we were just asking about interdepartmental sales. So now my question is, are we to treat intra-group sales the same way we treat interdepartmental sales? Is it the same thing?
Intergroup sales.
Yes, and interdepartmental
sales. Who can help us with that one?
Is it the same?
Eh? Who can help us with that one? Any idea?
Because the thing is, Mr. Pius, the way I understand the treatment, let me just break it down to see whether I'm correct or not. So because intergroup, when we say intergroup, they already form a company already. They are one already. So whenever there's a transaction between those between a company, within a company, definitely each department will treat it as a sales, but at the company level, when preparing their financial statements, they won't treat it as sales. Or I don't know if there's a way you can explain better, because I'm still confused about the treatment. Because I actually saw your question concerning that. That's why I need to ask.
Okay. Because of the time, let me just summarize something. All these questions are group questions. So we're talking about intergroup sales. Like I said, is a transaction between companies within the same group, like parents to a subsidiary or a subsidiary to a subsidiary. So, and for the, what is it called? Okay, you are asking for the treatment, Abi?
Yes, sir, treatment. That means the way they treat.
Are you asking for the treatment?
Yes, sir.
So no, we can't hear you.
Yes, sir, I can hear you, sir. The treatment.
Okay, so what of departmental sales? Yes, let me talk about that interdepartmental sales. They are just internal transfer of goods or services between different departments within the same legal entity. Like that is, for example, in the factory department, like selling a component to, let me say, another department, like from our accounting department to another, what is it called, HR department. So the accounting treatment on this, no elimination needed in external financial statement. There is nothing like elimination in the financial statement. So you have to use for internal performance evaluation and also a cost control. So transfer pricing are recorded in departmental accounting for cost analysis and for profit center evaluation. Yes, for profit center evaluation. I think it's different from group account. It's actually different from group account. It's different from group account. So like example now, Department A transfer goods to Department B at a markup cost. At a markup cost. So I think it's different from a group of accounts.
But Mr. Pius, I didn't wait. It seems you don't understand my question, sir.
Okay.
The logic is, I'm not talking about transfer pricing.
Okay.
You know, transfer pricing is more of like a department that is.
It's an internal sales, internal transfer.
Yes, internal transfer. But I'm talking about the sales. You know, if a parent sells to subsidiary or subsidiary sells to parent, as the case may be, the way they treat the sales, is it the same way they will treat the sales when a department sells to another department?
Yes. It's the same thing. It will have no impact in the financial statement. It's the same thing. Okay, I think I get you. It will have no impact in the financial statement. Yes.
Like for the company as a whole,
it's the same
not
thing.
For the department.
Yes. It will have no impact. It will have no impact. It's just for management use.
Okay, sir. Thank you, sir.
Yes. That is all the question, right? But Macaulay, you still raise up your hand. You still raise up your hand. But Macaulay, you raise up your hand. Do you want to ask a question before we call it a day? Okay. Read this one. Please, someone should read it. And from your own end, you can give us answers. Before our next meeting, please provide answers to this scenario. Can you see it? I hope you can see it. How you can see this question?
No, sir.
This is a practical question here.
No. Okay.
This one.
Okay. Yes, we can see it now. Okay, we can see it now.
So please, before our next meeting, I want to hear you guys saying something about this. Is that fine? Is that fine?
Okay, sir.
Yes, sir.
So thank you. For those that are joining us for the first time, I wish you success this diet. And for our existing students, I also wish you success. Please, no time to check time again. We have started. So please endeavor not to miss any class. And if you are to miss any class for any reason, watch the video. Go to the Telegram and watch the video. When you are watching it, if you don't understand it, any lecturer just ask the person that you should please explain a particular aspect to you. Please and please, it's what you pay for. So thank you and good night. Good night to you all.
Good night, sir.
Good night, sir.
Good night.
Good night, sir.
Enjoy your night, sir.
Good
Good night, sir.
Good night. Yes.